You are reading Fortune magazine. It is the year 2000. You flip to the annual list of America's most admired corporations, and there it is, for the 6th year in a row, one company sitting proudly at the top, Enron. You've heard the name everywhere. Your broker mentions it, your colleagues talk about it at lunch, the stock is soaring, the executives are brilliant, the innovation is breathtaking. This Houston energy company isn't just selling gas and electricity anymore, it's trading bandwidth, water, weather derivatives. It seems to have cracked the code on the future of American business. You feel safe investing in it. You shouldn't. Because behind those gleaming glass towers in Houston, behind the Fortune covers and the standing ovations and the Harvard MBAs walking the hallways like they owned the world, there is nothing. A hollowed-out shell of a company, propped up by the most elaborate financial deception corporate America had ever seen. By December 2001, your investment is worth pennies. Your pension is gone. And the company that Fortune once called the most innovative in America has just filed the largest corporate bankruptcy in United States history. This is the story of Enron, the rise. You need to understand how big this company actually was before you can understand how catastrophic its fall truly was. Enron was born in 1985 when a Houston energy executive merged two natural gas pipeline companies together. What started as a straightforward pipeline business transformed dramatically in the early 1990s when a sharp, aggressive consultant from McKinsey named Jeffrey Skilling arrived and rewired the entire company's DNA. Skilling's idea was audacious. Instead of simply moving gas through pipes, Enron would trade energy like a financial instrument, buying and selling it on open markets, speculating on prices, creating derivatives. He turned a utility company into something that looked and behaved like a Wall Street trading floor. You watch the stock climb from $7 in the early 1990s to over $90 a share by mid-2000. The company employs 25,000 people. It has operations in 40 countries. Analysts on Wall Street trip over themselves to issue buy recommendations. Nobody wants to miss out. And Skilling, alongside the company's founder and chairman, builds the perfect culture to sustain the illusion. Hire only the best, pay obscenely well, reward performance above all else, and never, ever admit weakness. The scheme. Here is what you don't know when you buy those shares. Enron's CFO, a sharp and ruthless financial architect named Andrew Fastow, has been quietly constructing a parallel universe of debt, a labyrinth of off-balance sheet partnerships with names like Raptor, Chuco, and LJM. These aren't real independent companies, they're shells, created specifically to absorb Enron's failing investments and mountains of debt so they never appear on the official financial statements the public sees. The troubled operations of the company are transferred to these so-called special purpose entities, essentially limited partnerships created with outside parties. Enron abuses the practice by using them as dump sites for its troubled assets. Transferring those assets means they're kept off Enron's books, making its losses look far less severe than they really are. But it goes even deeper than that. Skilling pushes the adoption of mark-to-market accounting, a system that allows Enron to book the projected future profits of a deal on the very day it is signed, even if that money won't arrive for years, even if it never arrives at all. Mark-to-market accounting allows the company to write unrealized future gains from trading contracts into current income statements, giving the illusion of higher current profits. So you read the financial statements and you see profit, massive profit, growing profit, the kind of profit that makes you reach for your checkbook. What you are actually reading is fiction, dressed up in accounting language so complex that even sophisticated analysts can't fully decode it. And the firm hired to audit all of it, one of the most prestigious accounting companies in the world, signs off on every page. Fastow himself pockets some $45 million from the partnerships he creates, profiting directly from the very structures built to deceive the public. The warning. In August 2001, you don't yet know that a vice president inside Enron named Sharon Watkins has just sent a letter to the chairman warning him that the entire company could implode in a wave of accounting scandals. Watkins sends an anonymous letter warning about the company's accounting practices. One statement in the letter reads, "I am incredibly nervous that we will implode in a wave of accounting scandals." The chairman reads it, does nothing decisive. 2 weeks earlier, the CEO had abruptly resigned, becoming the 6th senior executive to leave in a single year. The chairman tells a conference call with analysts, "I never felt better about the company," deflecting their pleas for more financial disclosure. You don't hear any of this. You just see the stock. Then October 2001 arrives and the curtain tears open. In October, Enron shocks investors when it announces a $638 million loss for the third quarter and takes a $1.2 million reduction in shareholder equity, owing in part to the CFO's partnerships. Shortly thereafter, the SEC begins investigating the transactions. The stock, which traded at over $90 a year earlier, falls to $33, then $15, then pennies. Now comes the moment that turns a scandal into a crime. On October 12th, the legal counsel at Arthur Andersen, the auditing firm, instructs workers to destroy all but the most basic Enron documents. Shredders run day and night, emails are deleted, thousands of documents tied to the audit disappear. On December 2, 2001, Enron files for bankruptcy. Its 25,000 employees lose their jobs, along with $2 billion in pension savings and $1.2 billion in retirement funds. Your investment, if you held shares, is essentially zero. The pension funds of teachers, nurses, and retirees across America are wiped out overnight. Arthur Andersen is found guilty of obstruction of justice for shredding thousands of documents and deleting emails and company files tied to its audit of Enron. One of the 5 largest accounting companies in the world, 85,000 employees, decades of reputation, ceases to exist. The reckoning. You watch the trials unfold over the next 5 years. The CEO is convicted on 19 counts of securities and wire fraud and sentenced to 24 years in prison, later reduced to 14 after he agrees to forfeit $42 million. He enters prison in December 2006 and is released in 2019. The CFO pleads guilty to 2 counts of conspiracy and serves 6 years, having cooperated with prosecutors and testified against his former bosses. The chairman, the man who built the company, the man who shook hands with presidents and sat across from the vice president 6 times to discuss energy policy, is convicted of 6 counts of fraud and conspiracy. He is facing more than 45 years in prison. He dies of a heart attack before he can be sentenced, July 5, 2006. He never spends a single day behind bars. In total, 22 people are convicted for their actions related to the fraud, including the CEO, president, CFO, treasurer, chief accounting officer, and heads of multiple business units. The lesson. Here is what you take away from the Enron story. You think financial fraud looks like a man sneaking money out of a safe in the dock. It doesn't. Sometimes it looks like a cover of Fortune magazine. Sometimes it looks like the most admired company in America. Sometimes it looks like an innovation story so dazzling that no one stops to ask the most basic question: where is the actual money? As a prosecutor would later tell a jury, this was not a case about accounting. It was a case about lies and choices. They chose to falsely assure the investing public that there were no problems at Enron. The smartest people in the room were lying to your face, and for years, you believed every word.